Can the Canada Revenue Agency, known as the CRA, the government agency who collects and administers taxes in Canada, can they come after you for someone else's tax debt? Surprisingly, yes, they have that power. It's called the Section 160 assessment, and in this video, I'll talk about how that can happen. Now, the reason I said surprisingly is of course that when you file your personal income taxes every year, you declare your income from all sources, you claim your deductions and tax credits and benefits, and at the end of it, either you have to pay the CRA or you're owed a refund. Your personal tax account is strictly between you and the government. You might claim things by virtue of your relationship with other people, like having a spouse or dependents, but whatever you owe the government, it's your debt and yours alone. It's kind of like your tab with the bartender. A Section 160 assessment is an exception to this. Section 160 refers to the part of the Income Tax Act, the main statute for tax law in Canada, which gives the CRA the power to come after you for someone else's unpaid tax debt. Now, clearly, there's a reason they would be coming after you specifically. It's not like when someone doesn't pay their taxes in Canada, the CRA just holds a lottery to figure out who has to cover that debt. The reason you could be held liable for someone else's taxes under Section 160 is because that person who owes the debt has transferred to you some assets. As I'll discuss later, you don't actually even need to be aware that you've been given these assets. So that person hasn't paid their tax debt, and yet they've given you their assets. And so in cases where the CRA feels there's a real concern that they won't be able to collect on that debt, Parliament has given them this extraordinary power to hold someone else liable for that tax debt. So when is the CRA allowed to use this extraordinary power? Here's the criteria that must be satisfied for them to make use of Section 160 assessments. This is what Section 160 of the Income Tax Act looks like. It's a little bit complicated, but luckily to make things easier, the Federal Court of Appeal in the 2008 case Livingston has clarified what all of this means into four main criteria. So first, the transferor must be liable to pay tax under the Act at the time of transfer. So the transferor here is the person that is giving their assets to someone else, the one doing the transfer. That person or entity must either have some tax debt that they owe to the CRA from before, or they're going to end up having some tax debt for the taxation year of this transfer. By the way, when it says that the Act, it's talking about the Income Tax Act. Number two, there must be a transfer of property, either directly or indirectly, by means of a trust or by any other means whatever. So a couple of things here. There has to be a transfer, meaning someone giving someone something. What is that something? It's called property here. When we say property in everyday language, a lot of times we're talking about real estate like land or homes or buildings, but property here is really speaking more broadly about assets. The meaning of property is defined in Section 248 sub 1 of the Income Tax Act, the definition section of the law. But ultimately, it's the assets that the CRA would come after to collect on its debt against a taxpayer. Usually this would be cash, however, it could ultimately be anything of value that the CRA could seize and sell to collect on its debt, like shares in public companies or real estate. The other thing that's mentioned here is that this transfer could be direct or indirect, meaning that the person doesn't have to give you the assets themselves. They could be done through a third party or some other mechanism that gets it to you. Using a trust to pay you would be one way of doing this, which is why it's mentioned. Number three, the transferee must either be 1. The transferor's spouse or common law partner at the time of transfer, or a person who has since become the person's spouse or common law partner. 2. A person who was under 18 years of age at the time of transfer, or 3. A person with whom the transfer was not dealing at arm's length. Alright, so transferee, as you might have guessed, is the person being given the assets. Now I should clarify at this point about the transferee and the transferor. Neither of these have to be actual people, human beings. I've been using people, giving people assets as my example to clarify things, but a lot of times in these Section 160 situations, the transferor is actually a corporation who owes taxes to the government and will transfer its assets to another corporation or an individual. So back to this transferee, this recipient. This transferee must meet the description of one of the following three categories. They have to either be the spouse of the transferor, a person who is under 18, or a person that the transferor was not dealing with at arm's length. The first two are pretty straightforward, but what does arm's length dealing mean? When two parties are dealing at arm's length, it means that they are independent from each other. They are pursuing their own self-interest, and they can't unduly influence or pressure each other, and they're in search of the best deal for themselves. As you can see, the first two categories of spouse and person under the age of 18 actually would also fit in as not dealing at arm's length. You and your spouse are not going to deal with each other at arm's length because you don't have sufficient independence from each other, and your interests may largely overlap. Similarly, someone who is under the age of 18 is likely to be unduly influenced by an adult, and so they lack the independence to pursue their self-interest. Section 251 sub 1 of the Income Tax Act talks about the meaning of arm's length, and it tells us that people who are related by blood or by marriage are deemed to not be at arm's length. The Federal Court of Appeal in Peter Cundall and Associates and the Queen gives us a more general way of analyzing whether two parties are dealing at arm's length or not. You can see it focuses on the factors that I was just mentioning, like whether there's independence, self-interest, and control between the parties. Okay, and now the last criterion for the CRA to make use of a Section 160 assessment. Number 4, the fair market value of the property transferred must exceed the fair market value of the consideration given by the transferee. Okay, so we have this term fair market value come up twice. What does that mean? Here's how the courts have defined this term, often abbreviated as FMV. The highest price expressed in terms of money or money's worth, obtainable in an open and unrestricted market between knowledgeable, informed, and prudent parties acting at arm's length, neither party being under any compulsion to transact. So basically, if you were to sell this asset in the market to people who are familiar with it, what is the best price that you could get? That's the fair market value of the property transferred. What then is the fair market value of the consideration? What is consideration? Consideration is what is given in exchange. So if you as the transferee are being given an asset by the transferor, what you give in exchange for that asset would be called your consideration. Consideration is a legal term that comes up in the context of contracts, because if there isn't consideration being given by a party, meaning if something of value isn't being given in exchange for something else, then the contract is not enforceable. So altogether, what this fourth requirement is saying is that the value of the asset the transferee is getting is more than whatever they're giving in exchange for it, such that they're essentially getting at least some of that asset for free. Now, why is this a problem? Because it means that the transferor isn't doing a legitimate transaction and selling their asset. Instead, they're giving their asset to someone to get rid of it and therefore not allowing the CRA to get it. So those are the 4 requirements that the CRA needs to make sure are met about the transferor, the transferee, and the nature of the transfer itself in order to make use of the Section 160 assessment and hold the transferee liable for the tax debt of the transferor. Now, something that might be shocking here is that the transferee, again, this is the person being given the assets, can still be held liable for the tax debt even if they don't know that the transferor has taxes owing to the CRA. Even more surprising is that a transferee who doesn't even know or consent to the transfer of assets to them can be held liable for that tax debt. So for example, let's say your uncle gives you a check one day, not related to any transaction, just because he's your uncle. You didn't know this, but your uncle owes some money to the CRA. He has tax debt. Next thing you know, you could be getting a letter from the CRA compelling you to pay that check to reduce your uncle's tax debt. And that letter isn't an option of, hey, do you want to help your uncle out? A Section 160 assessment means that it's now your debt. If you don't pay, the CRA will go after your assets. An even more bizarre situation is possible, where let's say your uncle sends you a bunch of money through PayPal. You never asked for it. In fact, you didn't even realize it happened. Let's say you don't even check your PayPal because you never use it. Well, the CRA realizes it's happened, and they send you a Section 160 assessment for the amount of that PayPal transfer, and again, you have to pay. This is actually similar to what happened in a case called Woodland and the Queen, where a husband transferred shares of a corporation to his wife's spousal RRSP account without her knowledge or consent. And even without her knowledge or consent of this share transfer, the CRA assessed her under Section 160 for the amount of the transfer, and the court held that to be valid. As the judge in this Woodland case stated, intention is not at all relevant in Section 160 matters, so it doesn't matter whether you intend to help your uncle avoid paying tax or whether you have any knowledge at all about the tax affairs of your uncle. All that matters is whether a transfer takes place that gives your uncle's assets to you and you not giving anything adequate in exchange, and your uncle has some taxes owing to the CRA. This being such a blunt and harsh tool for the CRA to use is why the Federal Court of Appeal in the case of Wanan described the Section 160 law as being draconian and recognizing the potential for unjust results. Now, there's at least one caveat to the application of 160, which helps make it not as draconian. It's what I alluded to earlier with my examples about your uncle being the transferor, and it's that if the CRA gives you a Section 160 assessment, the amount of your uncle's debt that you would be liable for would be the lesser of the amount he owes to the CRA and the amount that he gave you. So to clarify, if he owes the CRA $100,000 in debt and he gave you a check or sent you through PayPal $1,000, the most the CRA could hold you liable for under Section 160 would be the $1,000. In the case where your uncle owed $100,000 to the CRA and he sent you $120,000, you would be liable for the entire $100,000 that he owes to the CRA. But hey, at least you get to keep that other $20,000 for yourself. This lesser of amount rule actually comes from the wording of Section 160 in the Income Tax Act itself, specifically subsection 1E. So a lesson you might want to take from all this is that if you ever end up being given a bunch of money by family or friends, you might want to make sure that they're in good standing with their tax situation, not really to clear yourself from saying you didn't know they were intending to try and use you to avoid paying their taxes, because as I've mentioned, intentions don't matter for Section 160, there's just no due diligence defense that you can rely on. Instead, the reason you want to make sure they don't owe taxes is so you know whether you can blow through the money they gave you or whether you're going to have to pay at least some of it to the government. Now, you might be thinking, well, I don't have any scheming uncles, so this shouldn't really be a concern for me. But there can be scenarios where the transferor may not even be intending to evade paying their tax debt. For example, in the 2020 case of Dreger and the Queen, a father who was receiving a life income fund designated his two daughters as the beneficiary of the fund prior to his death. Once he passed away, $96,000 was transferred to his daughters from that fund. But because he had an outstanding tax liability of more than $96,000 from the year of his death, the CRA assessed the daughters for that $96,000 under Section 160. From the facts of the case, it doesn't appear that the father had any intention of hiding that money from the CRA. It was the life fund that he was living on, and he just wanted the money to be given to his daughters once he passed. And yet still, Section 160 applied. Just to reiterate that it doesn't always have to be the case that someone is trying to defraud the CRA when you might get caught up in a Section 160 assessment. In this Dreger case, the lawyer for the daughters went for a seemingly Hail Mary approach, arguing that Section 160 should not apply because the daughters and the father were actually dealing at arm's length. Remember, this is based on the third requirement of a valid Section 160 assessment, that the transferee and the transferor have to not be at arm's length. So the lawyer argued that because the father was dead at the time of this transfer, he cannot be considered to be in a blood relationship with the daughters, so that they were not at arm's length. As you can imagine, this argument didn't work. It's quite a stretch. But what I can appreciate is that the lawyer tried to use a precedent to support it, and so the court had to take it seriously. The lawyer was relying on a previous case called Kiperchuk, a case where a wife withdrew money from her husband's RSP that she was the beneficiary of after his death, and her withdrawal was assessed under Section 160 because her husband owed tax debt. In that case, the judge had determined the status of the marriage ended at death, and so the two spouses in that case were considered to be dealing at arm's length for the transfer at the time of the husband's death, such that Section 160 was not validly applied to the money that the wife had received. So the taxpayer in that case was successful at getting the Section 160 assessment removed. The judge in this case distinguished that Kiperchuk case from this one, saying that the status of marriage is a product of the provincial law, but a blood relationship like father and daughters is not a statutory relationship, it's a factual one. In other words, you don't stop being someone's child once they die, you're still their child, you were born to them. As a result, the Section 160 assessment in this case was upheld by the judge. So if you're ever labeled the transferee in a Section 160 dispute with the CRA, what can you expect? Based on the requirements of Section 160 from Livingston, most of these Section 160 cases that end up in court are based around arguments of requirement 4, whether there was consideration from the transferee for the transfer of property. And it's because the other three requirements are quite difficult to argue against in most circumstances. In most situations, the first requirement of the transferor having a tax debt to the CRA is easily verifiable. The next requirement of the transfer of the assets is also verifiable because the CRA has detected that transfer in order to put the Section 160 assessment on the transferee. If the CRA didn't know about a transfer, they wouldn't even know who to put the Section 160 assessment on. So if it's ended up in court, it's probably, again, something that's not going to be arguable. And the next requirement of non-arm's length dealing is, again, too easily met by being between blood relatives, spouses, or being between a person and a corporation that they control, or between corporations that a single person controls. That's why most of these cases that end up in tax court hinge on the fourth requirement, because the taxpayer, the person arguing that Section 160 shouldn't apply to them, has more things to work with. There's the fair market value aspect, where they can try and use different experts to value assets differently, because asset valuation is not a precise science. But more importantly, what counts as consideration and the value of that consideration is oftentimes the best tool that you have at your disposal. In cases like Muir and the Queen and Brown and the Queen, the taxpayers have been successful in getting the court to drop the Section 160 assessment, where they produce evidence that they entered into agreements to restrict the way that they were to use the money or assets that they received. So they established that they couldn't just do whatever they wanted with the assets that they received, and that the consideration for the assets they received was sufficient by restricting themselves to do what the transferor required of them. So for example, in the Brown case, the taxpayer was to keep the money she got from her spouse and use it to pay for her spouse's credit cards as he directed. In the Muir case, the amount transferred from the taxpayer's corporation to the taxpayer was solely to refund customers and repay creditors. It may sound weird that these scenarios would count as consideration, because when we think of giving something of value in exchange, we think of actually giving some sort of asset or service or right. But giving up the right to do something, forbearing from doing something, restricting oneself, can often be valid consideration, just like in these two cases. Of course, these are not the only ways to defend against Section 160 assessments from the CRA, but they're just an example of the type of cases that have worked for the taxpayer. On the other hand, what does not seem to work is when taxpayers transfer money from the corporations they own to themselves in the form of dividends, and then claim that there was consideration for those dividends. In Valovich and the Queen, the court stated that dividends are simply for shareholding, and there is no consideration for them as it pertains to Section 160. So to claim that dividends are received and in exchange for services rendered or for the right to a loan seems to be an ineffective legal argument. So that about sums up this exploration of the Section 160 power that the CRA has. I hope this isn't an issue you run into, and in an ideal world, you and those around you don't have tax debts, or if you do, you have some arrangement with the CRA to pay those debts, because if you don't have an arrangement to pay those debts, then the CRA will get afraid that you won't pay them, and then wherever they see your assets start going, including family, friends, corporations, trusts, wherever, they could be hit with a Section 160 assessment. Thanks for tuning in, and make sure to like this video and subscribe to the channel for more.